We are now just days away from entering into a brand new year of 2023. One of the hottest trending topics in the year 2022 worldwide, I would say, is definitely surging inflation. And today, let us talk about how inflation is going to affect the housing market come year 2023. From my past experience investing into the housing market, two of the main factors which greatly affect the housing market are, first, prices of the home, and second, the cost of your mortgage debts. Prices of housing are greatly dictated by demand and supply. If supply is higher than demand, it would surely have a downward pressure on the home prices. Similarly, if cost of borrowing increases, it would cause demand for housing to go away, and this in turn would also cause home prices to decline further. Interest rate hikes by the central banks would also directly affect the mortgage rate offered by banks to the home buyers and in turn affect the housing market. In this year alone, we saw Bank Negara raise the interest rate 4 times from 1.75% to 2.75% in an effort to combat the surging inflation which is happening currently on a global basis. Economists in general are keeping their view that our central bank, that is Bank Negara Malaysia, will raise the interest rate or OPR by another 50 point basis to 3.25% in 2023 amid expectation that inflationary pressure will ease. This has since caused the mortgage rate to skyrocket, making home ownership way less attractive. Allow me to elaborate the impact here further for you to see. In year 2020, the average mortgage rate was then around 2.9% per annum. If you were to take out a loan of 400,000 for 35 years, your monthly installment would be around $1,517. Now in 2022, average mortgage rate has since increased to about 3.9% per annum. Your monthly installment would also have increased by Ringgit Malaysia 230 per month to 1,747. Come next year, 2023, with OPR rate forecasted to hike by another 50 basis point, this would increase mortgage rate to 4.4%, which is back to pre-pandemic level. With this same loan amount, your installment would now have increased to Ringgit Malaysia 1,868 per month. This would be a total jump of Ringgit Malaysia 351 per month in your cost of servicing your mortgage installment. An increase of Ringgit Malaysia 351 in your monthly expenses may have little impact, but imagine if you have more than one mortgage loan to service. For myself, as an investor, we own multiple properties. Hence, naturally, we also have multiple mortgage loans to service. This year alone, we keep receiving notifications from various banks informing us of upward revisions in our monthly installment up to 4 times thus far. Imagine the total increase in our cost of borrowing is certainly making a big impact on our bottom line. We had no choice but to pass on the higher cost of borrowing to our tenants by increasing our rentals. Now, do you see how benchmark interest rate is in fact directly affected by inflation? Some of you may be asking, why do banks need to increase their lending rates to buyers as and when Bank Negara were to raise its benchmark interest rate? This is because banks need to increase the yield on mortgage-backed securities. So in order to do that, they would need to charge a higher interest rate on its lending to the borrowers. You see, when Bank Negara increased its benchmark rate in an effort to combat rising inflation, it would cause the treasury bond market to lose its appeal to investors at large due to the concern of a depreciating ringgit in the midst of a surging inflation. To entice investors to continue buying into treasury bonds, Bank Negara would then need to increase its yields. And since mortgage-backed securities is perceived to have higher risk over treasury bond, since treasury bond is a loan to government and government has rarely defaulted on their loan, the reward for investing into mortgage-backed securities ought to be higher than treasury bond. This explains why wherever Bank Negara or central bank raises its benchmark interest rate, it would result in higher yield in treasury bond and in turn banks would need to hike its lending rate in order to pay out higher yield to the investors on its mortgage-backed securities. In the gist, higher inflation means higher worry for the health of a depreciating ringgit, means higher return on treasury bond. When the return on treasury bond increases, this means the return on mortgage-backed securities would also have to go up even higher since it's perceived to be a riskier investment over treasury bond. Making sense? If inflation remained to be sticky or surge even higher into 2023, even if the Bank Negara were to stop hiking its benchmark interest rate, the higher inflation would still have an upward pressure on the mortgage rates. This is because inflation would always cause treasury bond yield to rise due to the concerns of the depreciating value of ringgit and in turn contribute to an upward pressure on the mortgage rate as elaborated earlier, which in turn would have a downward pressure on home prices due to declining demand in view of affordability concern. Malaysia's core inflation rose to a new high of 4.2% in November, driven by robust consumer demand and an improving job market. Headline CPI rose as much as 4.7% in August before tapering off to 4% in November 2022. It is worth noting that Malaysia's CPI still lags behind regional peers due mainly to the blanket subsidies on fuel, utilities as well as price control for necessary consumer food like chicken and egg. The good news for us Malaysians is that our new government prioritized in tackling the rising cost of living and hence continues to provide blanket subsidies in the near term before implementing target subsidies in the second half of 2023. And according to Bloomberg data, the consensus estimates for Malaysian CPI is 3% in 2023 based on the estimates of 31 economists. In view of this, we could safely assume that the mortgage rate would stop rising after the first half of 2023. This is where understanding how all the different aspects of economy comes into play when these different pieces of events come together. Hence, this is what makes continuous education an important element in our life, as ignorance is never a bliss but tragedy. When you are informed and educated, you would know how to get yourself prepared instead of panicking, and it also allows you to be able to make wise financial decisions so that not only can you take good care of yourself, but you could also protect your family members by understanding how to put the economy to work in your favor.